So if you wanted to actually attack the Bitcoin network today, it would cost you upwards of $5 billion in just specialized hardware alone.
Oh, yeah. At least.
Right. It's, for all intents and purposes, it's this impenetrable digital fortress. And yet this week, hackers walked away with nearly $40 million from individual users just because a software bug couldn't generate a random number.
It is the ultimate paradox of this whole ecosystem right now. I mean, the foundation has never been stronger or more secure,
Yeah.
but the perimeter, the places where you and I actually interact with the asset is just completely exposed.
Yeah, it's wild.
Okay.
Well, welcome to the week that was. Our mission on this show is simple. We take a towering stack of recent market analyses, data drops, industry reports, and we extract the real signal from the noise for you.
Exactly.
We are analyzing a week that's defined by heavy macroeconomic headwinds, striking shifts in how corporate treasuries are operating, a regulatory landscape that is just fracturing in real time, and, like we mentioned, some pretty severe vulnerabilities in the infrastructure.
Right. And to really understand what is happening, we have to move beyond just, staring at raw price action. We need to look at the structural changes occurring right beneath the surface that are actually driving the volatility you're seeing on your screen.
So let's start with that broader economic environment, because it really sets the stage for the turbulent price action we are seeing. The asset has been trading defensively, caught in this sort of ceiling between the $62,000 and $65,000 range. But what's actually keeping it suppressed in that channel?
Well, you have to look at the macroeconomic chokehold we are in right now. The Federal Reserve just executed a hawkish hold on interest rates, meaning they are maintaining that strict 3.50% to 3.75% policy rate.
Right.
And on top of that, Fitch Ratings downgraded the U.S. GDP growth forecast to 1.9%.
Okay, so if I'm listening to this, I might wonder, what does a slight downgrade in the national GDP forecast actually have to do with my digital asset portfolio?
It alters the entire landscape of systemic liquidity. I mean, when GDP growth slows down, but interest rates remain high to fight inflation, the actual supply of money circulating in the economy, what economists call M2, it just starts to shrink.
Money gets tight.
Exactly. Borrowing becomes expensive. And when capital is expensive, institutional investors drain money out of risk assets first. Add to that the recent energy shockwaves, where Brent crude briefly spiked to $100 a barrel before dropping like 5 to 7% after a U.S. and Iran military pause.
Right.
You end up with an environment where nobody wants to take unnecessary risks.
It's so crazy because the asset itself hasn't fundamentally changed, right? It's kind of like a cargo ship.
Yeah.
The ship is identical to what it was a year ago. Its cargo capacity is exactly the same, but the tide underneath it, that global M2 liquidity you just mentioned, is suddenly pulling away.
Yeah, that's a great way to put it. The water's getting incredibly shallow.
And we saw that play out with the spot ETFs recently. I mean, they experienced a brutal whipsaw. First, you have this 4-day outflow streak draining $526 million, which was then suddenly interrupted by a massive $233.1 million net inflow, driven largely by BlackRock.
Yeah.
So let's unpack this. If institutions are so skittish about inflation and liquidity drying up, why are we seeing these sudden heavy ETF inflows right after a streak of panic selling?
What you were looking at there isn't necessarily fundamental long-term conviction. It is mechanical reallocation.
Mechanical, like algorithms.
Exactly. Institutional funds rely heavily on mean reversion algorithms. When an asset hits the lower bound of a statistical trading range, in this case, around that $60,500 mark, these systematic buyers automatically step in to absorb the supply.
Oh, wow.
Yeah, they're literally programmed to buy the dip to maintain their specific portfolio weightings.
Wait, so they are buying the asset just because an algorithm told them it hit a floor. But does that mean they actually believe the floor is going to hold?
Not necessarily, no. And the options market data proves they're incredibly nervous. The reports indicate that the put-call implied volatility skew reached a positive 11.4 percentage points.
Okay, let's break that skew down for a second. What does a positive 11-point skew actually tell us about their mindset?
Well, a put option is essentially an insurance policy, right? It gives you the right to sell an asset at a specific price, protecting you if the market crashes.
Right.
A call option is a bet that the price will go up. So when the skew is heavily weighted toward puts, it means institutional players are willing to pay a hefty premium for downside protection. They are terrified of a drop.
So they're simultaneously betting the price will go up through their ETF algorithms, but paying top dollar for insurance in case it crashes. That sounds honestly less like conviction and more like institutional panic.
It is extreme defensive positioning. I mean,
Right.
they are actively defending that $62,500 support floor, but they are terrified of the macroeconomic headwinds. They
Mhm.
just have to adjust to this new restrictive reality where capital isn't free anymore.
And that defensive posture, it isn't just a Wall Street phenomenon. If capital is getting expensive for hedge funds, it's getting expensive for corporate boards, too. We are seeing a pretty profound divergence in how public companies actually manage their balance sheets right now. Let's look at MicroStrategy.
Yeah, let's.
They are the largest public corporate holder, and they just posted an $8.22 billion net loss.
Though it is very crucial to clarify that those were non-cash, unrealized losses on their holdings. They
Yeah.
didn't actually lose $8 billion in operating revenue.
Right, paper losses.
Yeah.
But the reaction to that paper loss is what is so striking. They actually paused their accumulation this week. Instead, they deployed capital to build a $3.75 billion fiat reserve. The stated goal is to guarantee dividend payments and service their debt for the next 2 years. Yeah.
But, I mean, their whole brand is acquired at all costs. Why are they suddenly building a fiat moat? Is the corporate playbook changing from acquire at all costs to, like, defend and yield?
Well, MicroStrategy is basically proving to the market that traditional corporate finance mechanics still apply to them. In a high interest rate environment, capital preservation and yield maintenance have to take priority over aggressive expansion.
Right. They have to survive.
Exactly. They have to show investors they can survive a prolonged liquidity drought.
So if you're listening and wondering how this affects your own portfolio, look at what these companies are doing, not just what they're saying. They are pivoting to capital preservation, which tells us they expect this high interest rate environment to stick around much longer than maybe retail investors might hope.
Yeah, unfortunately.
But then you contrast that defensive move with a China-based insurtech firm called Zhibao Technology.
Yeah.
They took a completely different path. Oh, the Zhibao deal. That is one of the most significant structural shifts we've seen recently.
Oh.
They executed a $154.7 million private investment in public equity, or a PIPE transaction. And the crazy part is, it was settled entirely in Bitcoin.
Entirely. They accepted 2,380 Bitcoin at a fixed valuation specifically to fund their AI development. This deal actually triggered a total boardroom restructure. But the part that really stands out is that they bypassed the fiat banking rails entirely. They didn't buy this on an open exchange and wire the money through a traditional bank.
No, they didn't. And this elevates the asset from just a speculative treasury reserve to a direct settlement layer for corporate mergers. I mean, the investor bought newly issued shares of the company and paid for them by sending the asset directly to the corporate treasury.
Wow.
By bypassing the fiat banking system, they sidestepped traditional capital market friction, correspondent banking fees, and all those international wire delays.
And we are seeing this shift away from simple speculation reflected in exchange revenues, too. Coinbase just reported $1.22 billion in revenue, and 88% of their net revenue now comes from non-spot trading. It's coming from subscriptions, stablecoins, and infrastructure services.
Right, because businesses and institutional clients are utilizing the underlying utility of the network now, rather than just, trading the token back and forth.
Okay, but you can't just step around the global banking system and expect governments to look the other way.
Right.
I mean, if I'm a regulator and a public company just settled a 9-figure merger on an unauditable rail, I'm panicking. Are we seeing agencies step in to stop this?
We are seeing an incredibly aggressive response on a global scale, which is then contrasted with absolute gridlock domestically.
How so?
Well, on a global scale, the U.S. Treasury recently sanctioned several Iranian state-backed entities. These groups were forcing maritime shipping companies in the Strait of Hormuz to buy transit insurance, and they required the payments to be priced and settled in Bitcoin.
Wait, really? They were deliberately using the network to bypass Western banking sanctions?
Exactly. It highlights the dual nature of neutral infrastructure. Anyone can use it, which forces the U.S. to aggressively enforce its economic statecraft by tracking the on-chain movements and blacklisting specific addresses.
So what does this all mean for us? The U.S. is aggressively targeting foreign use to bypass sanctions, while internally, agencies can't even agree on who regulates what. The Digital Asset Market Clarity Act is just stalled in the Senate over ethics disputes.
Yeah, the dispute centers on whether lawmakers should even be allowed to own digital assets while simultaneously drafting the regulations that govern them. It has brought legislative progress to a complete halt.
It's like playing a sport where half the referees are reading a completely different rule book. How do market makers even operate in this fractured landscape?
Well, institutions thrive on clarity, even if that clarity is imperfect. The legislative gridlock is noisy, sure, but the agency-level guidance is what actually allows traditional finance to build the plumbing, because federal agencies did clarify some rules.
Right, the SEC and CFTC.
Yeah, they put out a joint interpretation classifying assets like Bitcoin and Solana specifically as digital commodities. And the SEC just paved the way for yield-generating ETFs by allowing a 15% net asset value buffer for non-eligible assets on the Zhibao exchange.
Okay, so that 15% buffer, what does that actually do?
It's a crucial mechanical change. It allows the funds to hold a small portion of their portfolio in over-the-counter options. This opens the door for covered call ETFs and principal protected products, allowing traditional investors to generate yield on their holdings without taking on the operational risk of custodying the asset themselves.
Got it. And then the SEC also put out guidance on Rule 506C regarding on-chain tokenized attestations, right? Unpack that for us. How does a tokenized attestation change how a market maker operates?
So in traditional finance, if you want to invest in a private placement, a human compliance officer has to manually verify your tax returns and bank statements to ensure you meet the accredited investor net worth threshold.
Which takes forever.
Exactly.
Yeah.
But Rule 506C guidance allows a smart contract to simply read a cryptographic credential in your digital wallet. If a trusted third party issued you that credential, the smart contract verifies it in milliseconds. If you have the credential, the transaction settles. If you don't, it rejects.
Oh, wow.
Yeah. This gives traditional finance a clear, compliant pathway to automate their operations without waiting for Congress to resolve its ethics debates.
And then you look at prediction markets, and the legal system is totally fracturing there, too. A Wisconsin judge denied a CFTC injunction against state gambling laws, while other circuit courts are actively upholding federal preemption. Market makers are just going to navigate whatever rules exist today. They aren't going to wait for the perfect legislation of tomorrow.
Exactly. But pushing all this institutional capital onto the blockchain requires infrastructure that doesn't collapse under the weight.
Which brings us back to the dichotomy between the base layer and the operational edges that we mentioned at the start.
Right.
Let's examine the base layer first. A recent analysis by Charles Schwab highlighted that launching a 51% attack on the Bitcoin network today would require a $5.2 billion hardware capital expenditure.
It's staggering.
Yeah, and that doesn't even factor in the electricity, the real estate to house the servers, or the fact that sourcing that much specialized hardware would alert the entire market anyway.
It basically makes attacking the network economically unviable, and traditional finance is building market structures to match that continuous uptime. The Chicago Mercantile Exchange recently announced they are moving to 24/7 trading for crypto futures.
Wow, 24/7 trading?
Yeah, traditional derivatives markets are finally aligning with the spot market, which, never sleeps.
We are also seeing upgrades like the recent Stacks network hard fork, which they are calling POC Sykes 5. Now, without getting bogged down in the code, this introduces something called Bitcoin bonds. But how does that actually generate yield without users handing over the keys to their vault?
So POX stands for proof of transfer. Historically, if you wanted to earn a yield on your holdings, you had to lend them to a centralized company, risking total loss if that company went bankrupt.
Right, we've seen that happen.
Too many times. The POX 5 upgrade allows users to lock their assets in a smart contract on the base layer, retaining full control of their private keys, while validating transactions on the Stacks layer to earn a yield. It is a monumental step forward for minimizing counterparty risk.
Okay, so we have this virtually unhackable base layer, $5 billion to attack it, completely unviable. But earlier you said the perimeter is exposed. Where is the bloodbath actually happening?
You just have to look at the cold storage vulnerabilities discovered this week. A severe firmware flaw was found in Coldcard hardware wallets.
Wait, hardware wallets are supposed to be the absolute gold standard for security. What went wrong there?
Well, a hardware wallet secures your funds by generating a cryptographic seed phrase using a physical hardware random number generator, literally using microscopic thermal noise that is impossible to predict. But a software error in the firmware update essentially bypassed the hardware generator and replaced it with a predictable software generator.
So it reduced the entropy, meaning the passwords just weren't random enough?
Correct. And because the software generator was predictable, attackers were able to reverse engineer the seed phrases. They stole $38.3 million, nearly 600 Bitcoin, across 500 single-signature addresses.
Oh my God. And if that wasn't enough, two cross-chain bridges, AFX and Verus, were hacked for $31.6 million just due to logic flaws in their smart contracts.
Wow.
Are we basically building a titanium bank vault, but leaving the front door completely unlocked for the users?
That is the harsh reality of blockchain architecture. You have to distinguish between base layer consensus security and operational security. The reason the core network is a titanium vault is precisely because of how rigid it is. I mean, look at the BIP 110 dispute happening right now.
Right, BIP 110, that's the proposal aimed at limiting arbitrary transaction data, designed to stop things like ordinals and network congestion, right?
Yeah.
It only has like 0.92% miner support. So how does a failing upgrade prove the network is secure?
Because it demonstrates the extreme friction required to change the base rules of the protocol. The dominant software client refused to integrate it, and the miners aren't signaling for it. Achieving consensus to alter the protocol is agonizingly slow and difficult.
Right.
And that rigidity is a feature. It prevents tampering and ensures that the $5 billion attack vector remains purely theoretical.
But that same rigidity is what pushes all the innovation and all the risk outward to the edges.
Precisely. Because the base layer is slow and resistant to change, users who want yield or speed or lower fees move to the perimeter. They use cross-chain bridges with complex, untested smart contracts. They rely on hardware wallets manufactured by humans who write flawed firmware updates.
Humans make mistakes.
Exactly. The core protocol didn't fail in the Coldcard theft. It performed exactly as programmed. It verified the cryptographic signatures and processed the transactions.
It just doesn't care.
Right, the network doesn't care if your hardware failed or if you were tricked by a phishing scam. It only cares if the math checks out. The vulnerability is entirely in the operational custody.
So let's pull all of this together. We are watching a market being stress-tested from every conceivable angle. Macroeconomic headwinds and restrictive interest rates are squeezing systemic liquidity, forcing institutional algorithms into highly defensive postures. Corporate treasuries are evolving far past simple accumulation strategies. They are building massive fiat reserves to survive the drought, or, in the case of Zhibao, executing complex non-fiat mergers.
Yeah.
And while the core infrastructure is moving toward a mature 24/7 institutional model, the custodial edges remain a critical multi-million-dollar vulnerability.
It really is a market transitioning from adolescence to adulthood. The underlying plumbing is becoming deeply integrated with traditional finance, but the user interfaces still require an unforgiving level of technical competence.
Yeah, unforgiving is the right word. As we wrap up this look into the week's events, what is the one big takeaway you want our listeners to keep their eyes on moving forward?
I'd say think back to the precedent set by that Zhibao PE deal. It is very easy to get caught up in tracking ETF flows or options skew on a daily basis. But consider the operational shift that just occurred. A publicly traded company executed a $150 million corporate transaction, achieving final settlement without ever touching a traditional bank.
Right.
If a mid-sized technology firm can do that today, how long will it be until massive multinational supply chains start doing exactly the same thing? Not as a speculative investment to hold on a balance sheet, but as a pure medium of exchange to avoid currency controls, dodge correspondent banking delays, and eliminate settlement friction altogether. I mean, what does global commerce actually look like when the traditional banks are simply no longer required to clear the transaction?
That is a thought that changes the entire landscape. Watch what these companies do, not just what the price charts say. That's all the time we have for today. Keep your eyes on the data, and we will see you next time on The Week That Was.